All right, welcome to Finance 444. The only person enrolled in this class is Christopher Myers. So if you'd like to help me understand, if you go by Chris or Christopher, maybe just a quick email or text at some point this week, that'd be great. You and I can correspond and make sure that you feel comfortable with where you're at in the course. I haven't seen any of your work yet, but we're still at Tuesday after a holiday weekend, so I'm not worried about that. Just make sure, of course, like any other course, that you stay caught up in this course. The biggest difference between people who pass or fail a class like this is just getting in your work. So my name is David Shipley. I'm a certified financial planner. I work at Zions Bank as a planner and as a more of a hobby, but also a side job. I teach finance classes. I have for the last 7 years. So I've been doing financial planning for about 15 years in investments. And so this is a course or material that is something that I use every day. As far as the information that we talk about in the course, generally speaking, is information that I use every day with my clients and customers, managing their accounts, talking to them about options that they have, those types of things. If you'll participate in the class, if you'll listen to the sessions, I think there's a lot of material that you could pick up on that you then could take with you and benefit yourself the rest of your life. As far as different investments that you might do, 401ks, IRAs, retirement programs through work, might be things that you do on your own, different investments that you do, or it might even be just something to where understanding the material that we talk about in this class might help you be a better employee or a better employer or manager of an operation at some point, because most companies have to deal with investments at some level, whether it's investing in other companies, evaluating their own company as an investment for banks and for other companies to potentially purchase, or just using investments themselves as part of their operations that they have. So a lot of material that could be helpful. Hopefully you'll enjoy the class. I do go fairly quickly through these sessions, so nice thing is we'll be recording them. You can always go back and and if you need to review the material that we covered. Every single session will be covering some of the material for that week, as well as we'll always make sure that we spend some time at the end of each week going over the material, or at least the topics that will be on the quiz for that week. But just know that all the quizzes, all the tests, all the assessments for each one of these weeks, all 4 assessments come directly from the text. So if you have any questions or concerns about what will be on the test, it'll be the material that's covered that week, specifically the ebook material that's covered that week, because the author for those questions is the same author as the book. So this week, you've got chapters 12 and 13 about investing. And we'll be jumping around a little bit in the book as far as the material is concerned, but if you have any questions, let me know. We're going to talk a little bit about expectations tonight, then we're going to get some material from 12 and 13, cover some different material from 12 and 13, and then at the end, like we'll always do, but this week a little bit shorter than most, we're going to spend just the last 5 or 6 minutes talking about the 10 questions, multiple choice and true-false questions that will be on the assessment this week, so that you have the topics, or at least the material categories that you need to know that you can more purposefully research each week within the text, so that you'll know basically the topic that will be covered, the questions on the test. Okay. All right. So let's get into some minor things about expectations. Hopefully we don't have to cover a lot with expectations, and especially after this week, we won't have to cover anything with expectations. Should be all pretty straightforward, should be similar to other courses that you've had. But quickly, just to go over some different things that should be consistent from class to class. About 15% of your grade comes from daily checkpoints. If you stay consistent with them, they can give you an extra full letter grade worth of extra credit. So you need to complete and get right at least 5 of the checkpoints each week in order for full credit. And then, of course, there's 1 or 2 extras each week for some extra credit. So that's how the checkpoints work. Should be pretty straightforward, should be pretty easy, but if you have any questions on a checkpoint, let me know. Every once in a while there's an error in a checkpoint, and that's because the school came up with the checkpoints. I did not. I make mistakes too, but I just like to think that's the case. So if you have any concerns with checkpoints, you're welcome to zip me a quick email or text again, and we can visit about them. So that's the checkpoints. Really good opportunity to give yourself some buffer points if you struggle with a test or two or an assignment. The extra credit checkpoints can be the difference, of you getting the grade that you want or even passing, in some circumstances, a class like this. The next easiest thing that you do consistently in a class like this is the discussion boards. Discussion board is going to be a little bit different this mod, right? Because it's you and I, and that's it. So they'll just be you and I discussing different things and hopefully interacting a little bit on the board. But consistent with the expectation that a main post, okay, a main post with 2 to 3 paragraphs, the substantive paragraphs, along with at least 1 to 2 references, will be posted by Wednesday at midnight. So you've got till tomorrow at midnight to post your first main post, and make sure that it's answering the questions or specifically addressing whatever it is that the discussion board asks you to address. Okay. So if there are multiple questions, I'll be looking in your main post to make sure that you're answering all the questions that it asks. I'll be also looking to make sure that you've done some research. Now, the discussion board's a place where a lot of times I see some cut and paste jobs, a lot of research material, which is great. I don't mind the research material. I do mind cut and paste jobs. I don't want anything cut and paste. I do want you to cite and reference your research. I'm not going to grade you on whether or not you perfectly did APA format, but I am going to grade you on whether or not it's formatted in a way that I can understand that you are referencing material that you researched. And even more importantly than that, I'm going to be carefully looking for your opinions. The whole point of a discussion board is to have a discussion, right? To share your perspective, your experiences, and your opinions in most classes with the rest of your peers, right? In this class, you're just sharing them with me. So that might be more comfortable, it might be less comfortable. I'm not sure, just based on your personality, how that will be. However, it's an opportunity for you and I to discuss each week our opinions, our perspective on whatever it is the topic is that each week calls for from the instructions. So I want to see the bulk of what you're writing in your post, not in just peer responses, but in your main post as well. I want the bulk of that to be your unique perspective or opinions based on the research that you did. Not just regurgitating the material that you found, but also forming some kind of opinion. That's what the discussion board is for, to think through the material and then come to some conclusions and opinions. It's not a right or wrong thing. You're not going to get graded for right or wrong. I reserve the right to disagree with you. You reserve the right to disagree with me. We'll do so respectfully, and it should be a good discussion board. But your grade's not going to be impacted by whether or not my opinion is that you're right or wrong. Your grade will be impacted, however, if you don't provide opinions, perspective, and what it is that you've come to a conclusion on based on your research. Okay. So I am anxious to hear what your voice, your opinions, not just what you find online. All right, and then if you get 3 posts done, 2 peer responses, 1 main post, and all of them are completed by Saturday at midnight, you're eligible for full credit, right? Which is 60 points, 3 different weeks, right? We don't have the discussion board in week 4, so that's 180 points, almost 2 letter grades worth of points. Pretty easy way to get them from the discussion boards. If you have any questions on the discussion boards, just let me know. Zip me a quick email or text, and I can help you out with that. So discussion boards, checkpoints. The next thing that commonly is a hang-up in a class like this are the assignments. So you only have 3 assignments. However, they're worth more than a third of your grade. So in the class, more than a third of your grade comes from the assignments. And because of that, it's really important. Each one of your assignments is worth more than a letter grade of your overall score. So it's really important that you get all 3 assignments in. Obviously, I encourage you to get everything in on time. However, I do accept late work all the way up until the end of the mod. There are no exceptions to late work after the end of the mod. So Saturday at midnight in week 4, unfortunately, is a hard cutoff because that's just when the next mod starts, right? The school cuts that off because I have to submit grades and move on. So what does that mean? If you find yourself stuck in a situation with family circumstances, work circumstances, housing, health, something like that, where you have to turn something in a little bit late, beyond when it's due, I'll still accept it. You just will not receive full credit, right? So it'll be discounted, but you'll still receive most of the credit. So even if you do find yourself behind or a little bit, you're just not caught up in a class like this, I'll always encourage you to get as much of the work in as you possibly can before the end of the mod, right? Before the end of week 4. The other thing that's a little bit different with classes that I do is that I always accept resubmissions too, and I'll encourage you to resubmit your work if you've done something wrong in your assignment so that you can get additional points. So I don't offer extra credit beyond what's automatically available in the checkpoints, but there is extra credit in a way in that if you misinterpret something or do something wrong with the assignments, I'll always say, okay, here's what you did wrong. You're welcome to resubmit it, rework it, and I will give you some additional points for having done that. Okay? So those are assignments. I do accept late work. However, for full credit, I expect that you follow instructions of the assignment, turn it in on time so that I can give you full credit. All right, then we have an assessment each week. Weeks 1 and week 3 are small assessments, 10 questions each. Week 2 is kind of a midterm. It's comprehensive over the first 2 weeks of material. And week 4 is a comprehensive final exam over all the material that we covered. Again, it becomes more and more important both for next week with the midterm and then especially with the final that you listen and take notes from the session, that you know the categories and information that will be covered. There will be too much material. Okay, by the time we're done with this course here in just a few short weeks, there'll be too much material for you to go back and study all of it and understand all of it, memorize all of it. So instead of doing that, I'll encourage you to specifically and purposefully go and find the topics that I tell you will be on the test, okay, because I'll give you those topics during the sessions, and then you can make sure that you understand about those topics and have a more manageable study regiment before each test each week. Okay, I don't allow test retakes. Let's see what else. The tests are multiple choice and true false. There may be some matching. I'm not entirely sure at this point. There might be a matching question or two, but most of it's true false and multiple choice. And like I say, sessions will greatly help each week with your test taking. If you have anxiety about test taking, let me know. If you're willing to have a discussion about that, I have some tips and tricks that I like to share with people about how to really get well prepared for each test so that you don't feel rushed, so that you feel calm, so that you know that you're confident that you know the material that's going to be on it. And that tends to bring down the anxiety levels and helps you to not overthink things too. Sometimes the biggest enemy for people is that when they don't have a really good grip on the material, they tend to overthink each one of the questions and read into it more than they need to. Okay. All right. So you'll find on the course information page, you'll find a link for my information. It has my email address, david.shipley@stevenshenniger.edu. It has my phone number, 801-427-3989. You're welcome to text or call. But email and text are my preferred methods of communication because I have a day job. I'm not always able to get a phone call, and if I don't recognize your number, which I won't in a class like this, you could text me and I can get back to you, or you can email me and I'll get back to you within a day or so. I don't always answer the phone. So there you have it. That's how you communicate. As far as getting the grade that you want from the class, if you put in sufficient effort, if you follow instructions, if you turn things in on time, you should get an A. It's not one of these classes that you have to be a math whiz or really super dedicated and do 2 or 3 hours of homework every day to get an A. That's not what this is set up to be. It will take effort. It will take some diligence. It'll take learning some concepts. But if you're willing to put in the effort, it shouldn't be a class that's hard to get an A in, as long as you're putting in sufficient effort. As far as passing the class, I would just tell you, if you want to guarantee yourself to pass the class, the best way to get the best guarantee, and it's not 100% guarantee, but the best guarantee is to do all your work, right? Turn everything in, and you'll have the best chance for passing the class. In fact, it's very likely that you will pass if you do that. Okay. Let's see, one more thing, just a quick note about plagiarism. I won't talk about it again unless we need to, but just make sure that on your papers, on your discussion boards, that you're not ever using other people's material, especially other students or other research papers online, and just copying and pasting. I don't want to ever see that. What I want to see is your unique voice, right? I want to see your perspective, your opinions, and I do want you to research, but I want you to make sure and reference and limit the amount of quotes and references within your paper to a reasonable amount, right? Should be less than, let's come up with a rule that should be less than a third of your overall content should be quotes or directly quoted material that you're referencing from something that you found online. Okay. Any more than that, and that's way more than what you should have. Most of what you're writing should be your own writing, right? Opinions and perspective and examples and experiences that help the topic based on your experiences and research that you've done. Okay. If school policy is that if you plagiarize, you'll get a 0 on the assignment and a warning. If you plagiarize again after having documented a plagiarism situation before, they reserve the right to kick you out. So there's not a real high acceptance threshold for copying other people's work or turning in something else that's not yours. So be careful about that, and just make sure that you're being cautious and referencing material. I'm not trying to find somebody that's doing this. I've never kicked somebody out for plagiarism, but I have given some warnings because people got a little bit too close to just using somebody else's material instead of coming up with their own. If you have any questions on that, let me know. I'd be happy to clarify even further. We do have a learning coach for the class. I've posted her information already. I think they have a lab that you could go to that you can also be in touch with them directly and set up a time if it makes sense to look at something with them. They'd be happy to do that. Okay. I think that's all the expectations and course material that I wanted to cover. Just generally, kind of the housekeeping items before we get started. If you have any other questions or concerns, zip me a quick email. Like I say, it's just you and I in this class, and so if you've got questions, let's look at them and get right to them. Make sure that you're not stuck throughout this class. There's no excuse for that because I've got plenty of time and opportunity to help you out in any way that you need. Make sure that you pass the class and move on to your next thing. All right, so I mentioned before we want to cover chapters 12 and 13 as far as material, and then we also want to spend a few minutes at the end of class tonight talking about what's on the test. So here in about 35 minutes we'll do that, but in the meantime, let's go over some of chapters 12 and 13. 12 talks about stocks and bonds. 13 talks about investing in mutual funds and what mutual funds are, as well as exchange-traded funds. So before we get started, I wanted to give you a brief overview, just kind of some context on what stocks, bonds, mutual funds even are. Okay, a lot of the material in these two chapters talks about what they are, but to give you a little bit of basis before we get started on kind of pros and cons and what they're used for and what they're not, and risks and things like that, let's talk about what are we even talking about. How do you define a stock, a bond, or a mutual fund? So when we talk about stock, we're talking about equity interest or ownership interest in a company. If I own Microsoft stock, that means I actually own partial interest in Microsoft. However, since there are millions and millions of shares, if I own 1 or 2 shares, that I don't have enough ownership interest to have much control or say in what happens, but I still nonetheless have ownership interest in that company. That's what it means to be a stockholder. So if I own a share of Disney stock, I am a part owner in Disney. If I own a share of Zions stock, which is the bank that I work for, then I'm a part owner in Zions Bank. Now, you don't have a lot of control or influence until you own a lot of stock, okay? Sometimes millions and millions, even billions of dollars worth of stock are required to have a lot of influence with a company. However, even at a small ownership position, even though I don't have much influence or control, I still am a full participant in the upside of that stock, or in the upside, another way of looking at it, in the upside of that company. So if Microsoft does really well and I'm a Microsoft owner or shareholder, then my stock should, and usually does, do well. Usually goes up in value. Sometimes it pays me a dividend. And those are good things. Those increase the value in my stock position. If I invest in equity ownership in a company that's doing poorly or goes out of business, I can also lose my entire investment. So if I had invested in Enron shares a few years back, the energy company out of Texas, then I could lose all my money when Enron went bankrupt. Okay? So you want to definitely be careful about who you're investing in when it comes to stocks. You want to invest in companies you feel like will grow, because that will help your value of your stock position, your equity position, your ownership position to grow. So another way that we call stocks, sometimes we call them stocks, we call them equities, because it's an equity position, an ownership position. And we also can be called shareholders, okay, as stockholders. And if I am a stockholder, that means I've got an ownership position, albeit could be very, very small, and very, very limited as far as how much control or influence I have, but I still participate in the upside or potential gains and growth of that company. And also the downside, if there is downside, or potentially, if that company goes out of business, obviously that would be a negative, for my stock ownership as well. So that's what stock investing is. Why do we have the New York Stock Exchange, the NASDA, and the NASDAQ? Why do we have these different exchanges? The reason we have these exchanges is because this is where people buy and sell stock from each other. When I go to buy Microsoft stock, I'm not buying Microsoft stock from Microsoft. I'm buying it from another person who's selling it. And because there are millions and millions and millions of shares out there, a big company like Microsoft is always available for sale and always available for buying. So if I own Microsoft stock, there's always somebody willing to buy my stock. And if I am trying to buy Microsoft stock, there's always somebody willing to sell, because there are so many shares out there. With smaller companies, sometimes there are not people willing to sell, and sometimes there are not people willing to buy. We call that thinly traded stocks, and those stocks tend to be more volatile because their pricing doesn't level out with hundreds and hundreds and even thousands and thousands of people selling all throughout the day to each other through exchanges. Okay, so some people have the misnomer that they think that stocks are actually purchased from a company and the company benefits from me buying their stock. So let's say I buy a share of Disney stock, that somehow that helps them, and the answer is it doesn't actually. When a company does an initial public offering or a secondary offering, meaning they offer stock to the public for the first time or an additional time later on, that benefits the company when they first sell. But once those shares are in the marketplace and they're being bought and sold from each other, that no longer directly influences or helps the company that it represents. So when I buy Zion stock, the bank that I work for, it doesn't help Zions that I'm buying the stock. I'm just going out and buying it from another person who's willing to sell it to me. Okay. A little bit about stocks there. Then we have bonds, and just as a quick overview on bonds, bonds can also be called debt. They can also be called fixed income. Okay. So I can refer to bonds as fixed income or debt. Okay. Because the essence of bonds, the definition of a bond is a debt. Okay, it's a debt that is promising to pay back at some point with interest. So the only way that we're going to allow somebody else to borrow our money is if they give us the potential for growth, or if they give us income. And in the case of a bond, it's focused on income. When we give somebody like the city of Provo, which is where I live, if I give them bond money as an investor, I invest in them, and they bonded for like the Provo Rec Center, which is a recreational center. It's got a workout gym, it's got a pool, it's got all kinds of things. When I give them that money, they promise me that they will pay me back in the future at some date. Plus, they promise to give me interest. Okay, income and interest. And if they didn't promise me those things, I wouldn't give them money, right? There's a value to money, and people are only willing to give other people money if they're willing to, if they get something in return for it. That's why we put our money in a bank account, so we can get interest. Now, interest right now is really low, right? Horribly low. But if they didn't pay anything, we probably wouldn't even have our money at the bank. Okay. So anyway, bonds can be called fixed income, they can be called debt, or they can be called bonds. There's corporate bonds, government bonds, and municipal bonds. There are different kinds of bonds. We'll talk a little bit about that tonight. The bond market is very large. It's much larger than the stock market. But primarily, we've got individuals who trade in bonds, but primarily it's institutions, it's insurance companies, it's banks. They like bonds because they're predictable, they have a steady source of income, and it's a conservative way for them to invest assets. Okay, so that's a little bit about bonds. So bonds are debt, stocks are equity ownership. Then when we talk about mutual funds, and we'll dig into them a little bit more in chapter 13, but when we talk about mutual funds, we're talking about a pooled investment that can pool stocks or bonds or both. Okay, like there could be a balanced fund that has 65% stocks inside, and then 35% bonds. So it's a mixture of both stocks and bonds when we talk about a balanced fund or an asset allocation fund. But then there are pure stock funds, like a large cap growth fund is a stock fund that just invests in companies, stocks in companies that are large, like your Exxon Mobil's, your GE's, your Bank of America's, those types of companies. Or it could be a mutual fund that pools investments to invest in small companies. Okay, it just depends on the category that that mutual fund manager is managing. And there are lots of examples of mutual fund companies like Fidelity and Vanguard, two of the biggest ones. American funds, though, Putnam. There's all kinds of fund companies out there. It's a very lucrative business, and so there are a lot of mutual fund companies. We'll talk a little bit more about specifics of mutual funds in a little bit, but I just wanted to give you a heads up on what they are: stocks, bonds, and then a pool of stocks and or bonds that are pooled together as an investment. Okay. All right. So let's get into the specifics in Chapter 12. And like I say, as I go, if you were here, I'd have you ask any questions that you want while we're moving along. Since you're not here, what I would ask is that if you do have any questions as you listen to this later, that you would send me a quick email or a text or something like that, so that I can clarify immediately, right away as soon as possible. And you don't get left, you don't get left kind of, thinking, well, I'm just kind of stuck. I don't really get this. This is not tough material. It's a lot of material, but it's not tough material. If it's new to you, it might take a few times through before it makes any kind of sense. But I hope that you'll be patient with yourself if it is new to you and really learn it, because this is material that you'll come across over and over again throughout your lives. Okay, the first thing to understand when it comes to investments is that there are risks associated with them. People would not invest if they didn't expect some kind of return. But you wouldn't get any kind of return if there wasn't some kind of risk, right? There's got to be some kind of risk or there won't be a return. That's the risk-return trade-off that we're talking about this week on the discussion board. The whole basic premise for any kind of investing is that there is going to be some kind of trade-off between the risk that I'm taking and the reward that I get. And if I have to take more risk, I should get return that's commensurate for what the risk that I'm taking. So it should be appropriate for the risk that I'm taking. If I'm taking a lot of risk and getting a very low return, that's not a good investment. If I'm taking a little risk and getting a lot of return, then something's wrong in the marketplace, and there's a situation that'll probably reprice at some point, and it really will be too good to be true, because the gap will close and I won't be able to take advantage of that anymore. It doesn't mean that there aren't short-term opportunities like that, but most times the market reprices to a point where you're not going to be able to get a big return for low risk. Usually the risk-reward trade-off is consistent, meaning the more risk you take, the more return potential you have. And the less risk you take, the less return potential you have. But there's all kinds of other risks associated with investing, though. So there's business risk. A company could just go out of business. They could have a hard time selling, so they go out of business. There's financial risk, where a company's financials aren't strong enough. They aren't able to get financing. They aren't able to get the money that they need, and they have to close shop. There's market risk. So today the market was down 200 plus points. That's market risk. A lot of good companies in the stock market went down today, not because they're bad companies, but because the overall market went down, because we were worried about the hydrogen bomb test that the North Korean president did over the weekend, right? That made everybody very unsettled. We feel like things are escalating between he and Donald Trump, and at some point we're going to be throwing missiles at each other. Hopefully not. Hopefully that doesn't happen, but the market's worried about that. And so that's why the market was down big today, and that's why a lot of good companies went down. That's market risk. It wasn't anything wrong with those companies. So, if McDonald's went down today, it's not because McDonald's sold any less food today. It's just because the whole market went down. There's purchasing power risk, meaning that inflation is real. Over time, our money's worth less. So if I get back the same money that I have today, 6 months from now, it's not worth as much, right? So there's purchasing power risk associated with different investments that we have. There's interest rate risk. If interest rates go up or down, that can impact my investments. There's liquidity risk, meaning the ability for me to get to my money quickly. And then there's event-driven risk, like acts of terrorism. Even these hurricanes that we're talking about with Harvey and Irma, those are hurricanes that can create both positive and negative things for the market. You might say, well, how could it possibly put positive? Hurricanes like that sometimes, and Katrina was this way, even though it's devastating disaster and we never wish it on anybody, we never want that to happen, it actually increases GDP. So gross domestic product usually increases in light of a big natural disaster like that. And because of that, usually the market takes its cue from the GDP. So if GDP picks up, the market can pick up as well. The opposite can be true, though. If it's devastating enough, if it cripples a certain part of our market or a certain part of our economy, it can definitely create a problem for the stock market as well. It could go both ways when it comes to events. So lots of different risks associated with investing. There's actually other ones. But what are we trying to get when we take those risks, right? We better get something back. If we're not going to get anything back, we shouldn't take the risk. But usually we are getting something back. That's the point of it. So what are some different things that we can get? We can get income, we can get capital gains, and we can also have a compounding effect when we reinvest, and those reinvested interest or income or dividends are then growing as well. Okay, so current income, bonds pay interest, stocks pay dividends, real estate pays rent. Those are all current income issues from investing. Capital gains, so back to the example of bonds, stocks, or rental properties, all three of those can go up or down in value. If they go up, it's a capital gain. If they go down, it's a capital loss. All three of those instruments have the ability to go up or down, right? If I buy a house tomorrow, 2 months later, it might be worth less than what I paid for it because the market might go down a little bit in real estate. Same is true for stocks and bonds. They fluctuate very differently. Sometimes the stock market will fluctuate wildly one direction or another, while bonds and real estate tend to be a little bit more conservative, although we had a significant downturn in real estate just 4 or 5 years ago, right after the Great Recession in 2008, 2009. So we've got capital gains, current income, and interest on interest compounding effect, and all three of these can be a significant component of the return that we're trying to get by taking the risk that we take. Okay. Elements of return: 8% 20-year bond is going to turn $1,000 into $4,700 if you have an 8% return. If you have a 6% return, a 5% return over 20 years, you're only got $2,600, almost half as much. Okay. So the difference in rate of return, even just 1%, 0.5%, this comes into play when we talk about costs and fees and expenses as well. But the rate of return, especially when you're looking at long-term returns, is significant. It has a significant impact on how well you do as far as your investments are concerned. So it makes a lot of sense to be very careful and make sure that you understand costs and fees, but also that you understand what kind of rate of return is potentially there for you with the investments that you're making. Long term, the stock market has returned about 9%, depends on what term you're looking at, what types of investments, but the overall market's returned about a 9% return over the last 50 years on average, which means that if you know what the rule of 72 is, which is just whatever times the rate of interest that you're getting in years equals 72, that's the rate of return that you're getting. So that's how frequently you'll double your money. So if I'm getting 8% return, what is 8 times what equals 72? 8 times 9 equals 72. So that means every 9 years I'm going to double my money. Okay, every 9 years I'm going to double my money if I'm getting an 8% return. Which, if you think about it, if you could double your money every 9 years until you retire, that's 4 or 5 doubles, right, that you potentially have if you get started early with investing, which is the reason everybody talks a lot about starting as early as you can with investing. We're going to talk a lot about the risk-return trade-off on the discussion board, so I don't want to go there, but I think this is a helpful graphic. To the left, you'll see more conservative investments like U.S. Treasury bills and short-term Treasury notes. To the right, you'll see more aggressive investments like precious metals. You can see that common stocks are somewhere in between. Okay, long-term bonds, short-term notes, and Treasury bills, those are all considered types of bonds. So you see bonds are a little bit more conservative than stocks, than real estate, options, commodities, and precious metals. The interesting thing that I like to point out about this right here is that if you were to just listen to the radio about investing, you would think that precious metals were the most conservative of all. And in reality, it's just not true. Precious metals are not the most conservative thing. They're one of the most aggressive types of investments you can possibly be in. You can lose a lot of money very quickly, which is something that happened to gold investors over just the past short couple years. Gold was up at $2,000 an ounce just a year and a half, 2 years ago. Now it's at $1,300 an ounce. It got as low as $1,000. So at one point in the last year, people who had invested in gold just a couple years ago thought they were investing in something really conservative were down half. They had lost half their money in precious metals. So I just point that out because it's important to understand the risks associated with the types of investments that you're doing and not just count on advertisements to help you differentiate. Okay. All right, what makes a good investment? Well, a good investment is one that has future return, has yield, and gets us to our desired expected return. Okay. So how do we find out a yield? There's a complicated problem for that, even though it's not that complicated. They make it sound and look more complicated. We talked about what it means to be investing in common stock. We have equity or part ownership in that company, right? What does it mean to have residual ownership? The stock ownership is residual. That just means that if a company goes bankrupt, the bondholders get the value first, and if there's anything left after everything's been, divvied out to the bondholders, the debt holders, then we have residual interest in what's left. Now, what happens 9 times out of 10 when a company goes bankrupt is even the bondholders don't get made whole, and stockholders don't get anything. Okay, so when a company like Delta Airlines years ago, that's doing very well right now, but years ago when they declared bankruptcy, or like a General Motors or a Chrysler when they accept bailout money from the government because they're basically bankrupt, those 3 companies, everybody who was a stockholder at the time went to zero. They lost everything that they'd invested. And then what happens in all 3 cases is that they start over, right? Same name, same company, but they get to start over with new stockholders and raise money again. It's kind of a shady situation in corporate America that companies can bankrupt and then start over and raise a bunch of money again through a new public offering for new stockholders to benefit from, even though the old stockholders get nothing. Okay? And residual ownership just means that the firm's obligations for debt get paid first, which we've talked about. Stock market returns. You have voting rights, very little voting rights, but you nonetheless have voting rights for the board of directors when it comes to being a stock owner. You have tax considerations when you get income or when things grow. Bunch of key concepts with stock investing I'm not going to talk about. Something you should note for this week is that blue chip stocks, what are we referring to? Those are large, well-established companies like ExxonMobil, okay, like Walmart, like McDonald's. These are companies that have been around for a long time, and they're very large and well-established. They usually pay dividends. They're usually more stable, but it doesn't mean they don't fluctuate. They definitely fluctuate, okay? There's different types of stock. This gives you lots of different categories: large cap, mid cap, small cap. Just think in terms of large company, medium-sized company, small company. You got foreign stocks, international stocks. There are advantages and disadvantages to international stocks, of course, as you would guess. And then you've got bonds. And bonds tend to have more security. They tend to be more predictable. They have lower risk. They're more about preserving the money that you have instead of trying to grow it really rapidly. And they pay you consistent income, which is nice. Right here, they give you a graphic of stocks versus bonds. You can see for the last 20 years from 91 to 11, bonds actually are more steady, right? They're the green line. Stocks have been more volatile. They've been way up in the late 90s, and they fell apart in 2001, 2002, right after 9/11 and the dot-com bubble. Then they ran back up really fast, and then they fell apart again in 2008. And now, if this chart were to go out from 2011 through 2017, stocks would be way ahead of bonds again. Okay. So just to kind of fill that out for those of you who are looking at this saying, well, that's old. Well, if you were to compare them from 2011 to 2017, it would look much like the late 90s do, where it really separates and stocks do much better, which is what's happened over the past 5-6 years. Stocks have done really, really well, and bonds have been so-so. Okay. All right, I think that's all we want to cover as far as stocks and bonds are concerned. I'm going to stop there with this particular set of slides and move to a different set of slides. All right, now we're on chapter 13, investing in mutual funds, exchange traded funds, and real estate. We're not going to talk about investing in real estate tonight. That is part of the chapter, and you're welcome to explore it. A lot of people I find in classes like this already have really done a lot of, potentially have really looked into real estate. If you haven't, the book does have some material on it, and there is lots and lots of material out there online that's easily accessible that you don't have to pay for to get information about investing in real estate. I don't consider myself a real estate expert. I do consider myself experienced and expert when it comes to investing in mutual funds, exchange traded funds, stocks, and bonds. So that's one of the reasons that we won't spend a lot of time with real estate, although I do think it has merit, and a lot of my customers and clients have made significant wealth investing in real estate. Okay, so nothing against real estate, just not an area of expertise or an area that we have a lot of extra time tonight to cover. All right, so mutual funds and exchange traded funds, what are the basics? Basically, it's companies, financial organizations organize a pooled fund to invest, and we as individual investors invest in that pooled fund, and then they make decisions regarding how it's invested. So right here it says more people invest in mutual funds than any other financial product. That's true. Mutual funds are ahead of, above any other type of investment product for the average individual in America, and most of it comes from the fact that a lot of people are investing in mutual funds within their 401ks at work, right? It's not that everybody goes out there and says, hey, I want to buy mutual funds. It's that most people's work retirement programs are invested in mutual funds, and so that's what they're in. Having said that, for the average individual investor over the past 10 years, ETFs or exchange traded funds have become more popular as far as new flows, new money into them. So as a percentage of how large they are, ETFs are growing much faster than mutual funds have been growing over the past 10 years. ETFs are kind of the new financial product of the last 10 or 15 years, where people are getting excited to be in a new product that's different. Very similar to mutual funds, usually has a little bit lower cost. So obviously that's an appeal to exchange traded funds or ETFs. But what is the concept? It's a pooled diversification. It's I can put a little bit of money into a mutual fund, okay? I can put $100 into a mutual fund, and that mutual fund will go out and invest in 1,000 different stocks. So I'm highly diversified with my $100, right? Because I get pooled, my investment gets pooled with everybody else. So that mutual fund manager might be managing $1 billion, but I only, of that $1 billion, I only have $100 in that fund. But if I were to try to go out and buy 1,000 different stocks on my own, it'd be very costly, first of all, because I'd have to have a trade fee for every single one of them that I did, and I wouldn't be able to even do it because most trading platforms require you to trade in actual shares. So if I went and tried to buy, for example, Berkshire Hathaway is a $150 stock. Well, if I'm only trying to put $100 in, I can't even buy Berkshire Hathaway. And that's only one position, right? Let alone, getting hundreds of different positions that I usually get from a mutual fund. So it's a way to use economies of scale where a mutual fund manager is managing millions or billions. I'm only got my, $100, $1,000, whatever it is, a smaller amount, but I still want to be highly diversified. This is a way for me to be highly diversified without having to invest in all those different companies myself. There's some other issues. So not only am I diversified, but I also have a manager that's professionally managing my investments. Okay, this is somebody who's expert when it comes to picking stocks or bonds, and so that's nice, right? Especially for those of us who don't feel like we're expert in doing that. So sometimes the financial returns are very good, and very importantly, it's very convenient. It's very easy. Vanguard and Fidelity have made lots and lots of money over the past 20, 30 years because they make things very simple for people to be able to invest on their own, but yet have very good returns, very low fees, and good management, when it comes to what they do. So that is why mutual funds are so popular, is because they're diversified, they're professionally managed, they're easy to get into, and there's good returns. Different components of a mutual fund, or mutual fund exchanging hands. You've got the management company that actually is managing the day-to-day operations of the fund, buying and selling stock, managing what's going on inside of it. Then you've got an investment advisor that oversees a portfolio of different funds. That's what I do for a living. Then you've got a distributor that sells the funds. Okay, got different vendors and distributors. And then you've got a custodian that safeguards the fund's assets. Usually that's a bank. And then you've got a transfer agent that could also be a bank, but is in the business of transferring and maintaining records, transferring money and maintaining records. Okay, so a lot of different components just going into a mutual fund and how a mutual fund changes. So you'll want to know the basic difference between an open-end and a closed-end investment company. Open-end investment company is a mutual fund company. Okay, there's a mutual fund that you can buy and sell at any time. If you buy it, you're actually buying it from the mutual fund company. You're not buying it from somebody else like we talked about with stocks and bonds, where you buy in a secondary market from someone else. When it comes to mutual funds, you don't buy from someone else. You buy directly from the mutual fund company themselves. They issue shares to you. And when you go to sell, you actually sell your shares back to that same mutual fund company. Okay, so they trade differently than stocks. Closed-end investment companies are different. They have a fixed number of shares that they release, and then they trade between investors in the market, much like stocks. They trade much more like stocks than do open-end investments. So just a different nuance. They're still pooled. They still have professional management, but they trade more like stocks. Now, closed-end investments have become less popular, less common the past 5 or 10 years that I've been in this business of investments. Open-end mutual fund companies are still the dominant players when it comes to volume of investments and where they go. So what does it mean when we say NAV? NAV is a net asset value. It's actually the value per share of a mutual fund. So a mutual fund values their shares on a daily basis, and that value comes from, how they determine that value comes from the underlying positions, obviously, and also how many shares, and also the costs and fees associated with running the mutual fund. So what you take is you take all the pricing of all the different stocks and bonds at the end of the day, you aggregate them, you minus out your liabilities and costs, and then you divide by the amount of shares that you have, and that gives you your NAV, or your price per share. Okay, and that price going up and down is what determines whether or not you and I, as investors in that fund, go up or down in value. Okay, which makes sense, right? You would expect that if the price of all the stocks that a mutual fund company holds goes up, then you would benefit from that, and the price of your shares of the fund would go up. And that's, in essence, it's a little bit oversimplified, but that's in essence what is happening. Price of all those underlying investments goes up, then your mutual fund will go up. Exchange traded funds, they trade more like closed-end funds. They're a little bit less expensive. They usually have categories, but they can be professionally managed as well. And yet they can change, so they've got some similarities to both open-end funds and closed-end funds. One of the main things that people really like about ETFs is the ability to trade them like stocks. They can trade them all throughout the day, where a mutual fund, you can only trade them one time at the end of each day. Okay, because the mutual fund reprices, and that's how they know how much the mutual fund's worth, because it only reprices once a day at about 4 p.m. Mountain Time, or closer to 6 p.m. Eastern Time, right? When they can finally reprice and figure out what their pricing is. Here are some different exchange traded funds that are very common. SPY and QQQ are very, very common ETFs. But some of these other ones, like XLF, the financial sector, is very common as well. These are very inexpensive ways to invest in these different categories. So if I wanted to invest in the bond market, AGG would be a great way to do it. It's very low cost, and it gets me what bonds do. If I just want to invest in whatever the market does, the S&P 500 through SPY is a great way to do that. Very low cost again. But all it's going to do is just track that category. It's not being professionally managed. In this case, these exchange traded funds, now there are professionally managed exchange traded funds, but in these cases, these examples that they give here are not professionally managed in most cases. They're just a computer generated index that follows whatever category or index it's trying to follow. You got load versus no load funds. Load funds charge commission up front, no load funds do not. Usually you'll find load funds within advisors and no load funds online directly. However, nowadays it's much more common for advisors to use no-load funds as well. When it comes to my business, almost all of the funds that I use are no-load funds, even though I'm an advisor, right? So how do I make money? I charge people a management fee on an annual basis to manage their accounts, instead of charging upfront commissions like people in my business used to do. 10 or 20 or 30 years ago, you used to have to pay upfront a commission basically to get into a mutual fund. Now that's more uncommon. It still happens, but it's more uncommon. We talk about different fees, talk about how to look at different mutual fund quotes. American Funds, which is one of the fund companies that I mentioned earlier, one of the largest, one of the biggest funds in America. This would be, a listing that you could find in like the Wall Street Journal that would tell you, net of its costs, what's the year-to-date return for these different funds. And for example, if you look down, the Washington, it's actually the Washington Mutual Fund at the very bottom underneath American Funds category, was up 9% year-to-date that year. It's a pretty good return. But you could check on all these different ones. So there's all kinds of different types of funds. That's what determines what's inside of the fund. If I have a growth fund, it's going to be all stocks. If I have an income fund, it might be a stock bond mix with stocks that focus on dividends and bonds, or it could be all bonds, right, that are focused on income. So these are all just different types of mutual funds that are out there that you could invest in. You got different types of bonds. We've talked about that: government bonds, mortgage bonds, municipal bonds, convertible bonds. There's all kinds of different bonds, and if you wanted a particular type of bond fund, you could find those bond funds and then research and screen for the best one in its category. Okay, lowest cost, highest returns historically. All right, all different kinds of funds, but that's the general overview that I wanted to get through for mutual funds and ETFs. So now that we've gone through that, let's take just a few minutes and go through what will be on the test. Take me just a minute to bring up the page that I've got that has my test notes. All right, so we've got, as I mentioned before, 10 questions on the test this week. They are not difficult questions. They come straight from the material. So let's go to question one. Question one, you just need to know the definition. You need to know the category of stocks, and we mentioned it tonight. We actually referred to this terminology when we were talking about stock investing, but we need to know the type of stocks that are kind of stable and older companies, big, stable, older companies. What do we refer to those types of stocks? What category of stocks are those? Okay, if you get that, you'll get that one right. Number two on the test, need to understand what it means to be a common stock holder or a bond holder. We talked about how stockholders have equity ownership and bondholders have debt, right? If you understand that, you'll get that one right on the test. Number three on the test, you need to understand the concept of yield. Yield just means the amount of income you're going to get. Now, most investments have a fixed dividend or interest rate associated with them. Okay, so let's say I have an investment that pays a 5% coupon. In the world of bonds, we refer to their interest rate as coupons. That means it pays me 5% per year. If the price of my bond goes up, my effective yield on that bond goes down. If the price of my bond value goes down, my effective yield goes up. Okay, so why does that? Who cares, right? Well, when I'm investing in something that pays income, I'm more anxious and needing to understand my yield than I am the actual coupon. Okay, so let me give you an example of this. If I were to buy a piece of real estate for $100,000 more than it's worth so that I could get the rent, because I was really excited about the rent, then my net effective yield on that is much lower because I had to overpay for it to get that coupon, right? To get that rent. If I pay less than what it's worth, then my effective yield on that property and those rents is actually higher. The same is true for bonds and for stocks. The higher the price, as the price goes up, the yield goes down. As the price goes down, the yield goes up. There's inverse relationship between price and yield. If you understand that, you'll get number 3 right on the test, or at least just memorize that concept that we just mentioned. So when it comes to bonds, they all get rated. The higher the bond rating, the lower the interest. Again, inverse relationship between bond ratings and return. Why is that? Because the riskier the bond, the more they have to pay us in order for us to invest. So if you're a risky bond, you have to pay a higher coupon or higher interest rate than one that's higher rated. So higher the rating. If I'm a triple A bond, I don't have to pay very much in interest. If I'm a triple C bond, which is a lower grade bond, then I have to pay a higher interest rate. Number 5, you need to know the definition of business risk according to the book. What is the definition of business risk? Number 6, you want to know examples of what the book refers to as event risk. What is event risk? Number 7, again, business risk. Need to know the definition of these different risks that were listed out. Number 8, we listed out the different people associated, different groups associated with a mutual fund, right? We had a distributor, we had a money manager, we had all these different positions. Just make sure you understand basically what those different positions are and what they do. You'll get number 8 right. Number 9 on the test. What are some advantages of mutual funds? You'll get that one right. Number 10 on the test. What's another name for mutual funds? What's another name for mutual funds? There's another word or a set of words that's synonymous with mutual fund. And you'll get number 10 right if you know that. So what does the book say is another way to, what else can we call mutual funds? All right, you'll be in great shape if you've taken a few notes from tonight and the material we just covered. If you've got any questions as you review this session about the material that will be on the test, just more clarification on that, I'd be happy to give you some feedback. But that's all I have for tonight. Have a great week, and hopefully you can make next week's session. And I look forward to chatting with you on the discussion board. Have a great night.